Namaskaram. So let us do some questions based on residential status and scope of total income, and let's try to understand the combination and impact of section 9(1) over the residential status or over the non-resident assessees who are earning income from India or deemed to be accrued in India. First question. Piyush, who returned to India on 12th June 2020 for permanently residing in India. So he has not come to India for a visit, he has come to India to stay. So from 12th June onwards, he will be there in India. After a stay about 20 years in UK. So you need to know with this particular sentence, the preceding stage will be 0. Here number of days stay in India during the preceding 4 years, preceding 7 years will be 0. And he provides the sources of his various income and seek your opinion to know his liability to tax thereon in India in assessment year 21-22, assuming that he does not want to opt provision of section 115 BAC, that means normal taxation. He is having income of a rent of a flat in London, which was deposited in a bank there. The flat was given on the rent by him after his return to India since July 2020. So July 20 to March 20, this particular property is earning rent, where the foreign rent is taxable in India. For that, you need to determine the residential status. And my dear friend, if you determine the residential status of this assessee who is in India from June onwards, obviously he stayed in India during the previous year is more than 182 days. So he will become a resident, but because he was not there in India for last 20 years, he will become resident and non-ordinary resident because he cannot satisfy the conditions of 730 days out of 7 years and 2 years of resident out of 10 years preceding to previous year. So we are talking about residential status of or scope of total income of non-ordinary resident here. And for non-ordinary resident, income which is accrued in India, received in India, deemed to be accrued in India, deemed to be received in India, meaning thereby Indian income is taxable, and out of the foreign income, only business control from India is taxable in India. Okay. Dividend on shares of 3 German companies which are being collected in bank account in London. So accrued outside India, received outside India. He proposes to keep the dividend on shares in London with the permission of Reserve Bank of India. Okay. He has got 2 sons, one of whom is a 12-year-old and other is 19-year-old. So this is minor, this is major. Both of his sons are studying in London, staying in London and not returning to India with him. Each of his sons having income of 75,000 in UK foreign currency, not received in India, and 20,000 in India. Obviously, whatever income sons are earning outside India, they are non-resident, is not even taxable in India. Yeah, Indian income is taxable. So far as major son is concerned, the income will be taxable in the hands of major son. So far as minor son is concerned, the income will be clubbed in his hand after providing 1,500 exemption, if you remember, under section 1032. During the preceding accounting year when he was a non-resident, he had sold 1,000 shares which were acquired by him in a British pound sterling, so foreign currency. He had purchased some shares in foreign currency, and the sale proceeds were repatriated. Repatriated means it was money received and accrued outside India and then it was transferred to India. When some money is transferred to India, you have learned this word, past untaxed profit. Past untaxed profit is not an income, and because past untaxed profit is not an income, it cannot bring to tax. Repatriation is not income received in India. The profit in terms of British pound sterling on sale of 1,000 shares was 175% of the cost. At 37,500 in terms of Indian rupee, it was 50,000. Okay, so that data is not that much relevant. Look at this. How do you present? Piyush returned to India on 12th June 2020 for permanently residing in India after staying in UK for 20 years. During the previous year 2021, he stays in India for 293 days. Okay, from 12th June onwards you have to count. Okay, since he has stayed in India for a period of 182 days or more during the previous year, he would be resident in India. Obviously, the resident in India. However, he would be resident but not ordinary resident, assuming that he was a non-resident in 9 years out of 10 previous year preceding to 2021, and his stay in India during the 7 years is a less than 730 days because they have given the data in such a way. The residential status of Piyush for year AY 21-22 therefore is a resident but not ordinary resident. The moment you say NOR, you need to understand the scope of total income. As per section 5.1, only income which is received and deemed to be received or accrued or deemed to be accrued in India, that means Indian income, okay, is taxable in case of resident and non-ordinary resident. Income which accrues arise outside India, foreign income, shall not be included in his total income unless it is derived from business controlled in or profession set up in India. So what do you need to know about NOR? So Indian income is taxable, yes. Foreign income but business controlled from India or profession set up in India is taxable. But pure foreign income means foreign rental income, foreign dividend income, this is not taxable in case of NOR. Yeah, if it was OR, even that income would have become taxable, but this income, pure foreign income, is not taxable in the case of non-ordinary resident. A rental income from a flat in London which was deposited in bank there shall not be taxable in case of resident but not ordinary resident, since both accrual and receipts are outside India. Dividend from shares of 3 German companies collected in a bank account London would also not be taxable in the case of resident and non-ordinary resident, since both of the accrual and receipt of income is outside India. Very nominal. As per section 64(1)(a), clubbing of income chapter, all income accruing or arising to a minor child is includable in the hands of the parent after providing the deduction of 1,500 under section 1032. Accordingly, income of 20,000 accruing to his minor son age 12 years in India is includable in his income of the Piyush after providing 1,500 exemption. So the net income is 18,500 includable. Income accruing to the minor child outside India, which is also received outside India, is not includable because that income itself is not taxable in India. See, in clubbing chapter, we don't club any income of a minor. We club income only if it is taxable in India. First of all, you have to think about taxability, then the chargeability, who will be paying tax on that particular income. Since the other son is the major, his income is not includable in the hands of Piyush. Repatriation of sale proceed of 1,000 shares sold in the preceding accounting year when a Piyush was a non-resident is not taxable, since it is not an income itself. It's not an income, it's just a past untaxed profit you are bringing to India. Consequently, only income includable would be total income. So only 18,500 is his total income, and the tax liability will be definitely nil because it is below basic exemption limit of 2,50,000. Next question. Mr. David, a citizen of India. First of all, first condition, Mr. David is a citizen of India serving in a Ministry of External Affairs in India. So, he is the Government of India employee. Second condition, was transferred to Indian Embassy in Canada. Third condition, he is serving outside India. On 31st March 2020, last year only he was transferred. He did not visit India any time during the previous year. So, definitely he is a non-resident. His status is non-resident. He has received the following income. So what type of incomes are taxable in the hands of non-resident, my dear friends? Only and only Indian income. So what about salary? Yes, it is deemed to be accrued in India according to section 9(1) clause 3, if you remember. So salary, yes, it is taxable. Foreign allowance, exempt. Interest on fixed deposit from bank in India, taxable because it is accrued in India. Income from agriculture in Pakistan, usually foreign agriculture income is taxable, but this is a foreign agriculture income earned by foreigner, non-resident, so not taxable. Okay, income from house property in Pakistan, not taxable. Compute the gross total income for the assessment year 21-22, very much easy. As per section 6.1, Mr. David is a non-resident for the year 21-22 since he was not present in India at any time during the previous year. And as per section 5 subsection 2, a non-resident is chargeable to tax in India only in respect of following incomes. 1, income received in India or deemed to be received in India, accrued in India and deemed to be accrued in India, that is Indian income, only Indian income. In view of above provision, income from agriculture in Pakistan or income from house property in Pakistan would not be chargeable to tax in the hands of the David, assuming that the same were received in Pakistan. Income from salaries payable by a government to citizen of India for services rendered outside India, okay, is deemed to accrue or arise in India according to section 913. Hence, Such income is taxable in the hands of Mr. David even though he is a non-resident. However, any allowances or perquisite paid or allowed to such individual outside India by government is exempted under section 10(7). Hence, foreign allowances of 4 lakh is exempted, not taxable. So, how do we compute gross total income? This is deemed to be accrued in India according to section 9(1) clause 3, and this is actually accrued in India 1 lakh. So, gross total income is 6 lakh. Very easy question. Next one. Mr. A citizen of India, left for USA for the purpose of employment on 1st May 2020. So, you need to know Mr. A was citizen of India and he is leaving India. That means you can assume till 1st May 2020 he was there in India itself. And you know that for a citizen of India who leaves India for an employment, the condition of 60 days is not applicable. The condition of only 182 days is applicable, isn't it? And therefore, he can become a resident only if he stays in India for 182 days or more. He has left only on 1st May. So, April 30 days and May 1 day, only 31 days he has stayed in India. He has not visited India thereafter. Therefore, his status is a non-resident. Scope of total income is only Indian income. Mr. A borrows money from his friend and Mr. B, who has left India for employment purpose 1 week before Mr. A's departure, to the extent of 10 lakh and buys the shares in X Limited Indian company. What is happening here? Mr. A borrowed money from his friend Mr. B, who left India for the employment purpose. Okay, 1 week before Mr. A's departure, to extent of 10 lakh rupees and buy shares in X Limited. So, Mr. A has borrowed the money and he has invested in shares of Indian company. Discuss the taxability of interest charge at the rate of 10% in B's hand, because B is earning income now. If the said interest has been received in New York, the income is received in New York. Let's see. An individual is said to be resident in India in a previous year if he stays in India during the year for 182 days or more, or has been in India for total number of days 365 during the 4 preceding year, and he is there in India at least 60 days or more in that year. But this 60 days condition is not applicable for, please understand, the 60 days condition is not applicable for person who has left India for an employment outside India. For that particular person, the 60 days is replaced by 182 days, meaning thereby effectively somebody who is leaving India for an employment outside India will become resident only if he stays in India for 182 days. We have discussed this in residential status. In this case, Mr. A is an Indian citizen who left India for an employment outside India. Mr. A has been in India only for 31 days. Since his stay in India during the previous year 2021 is only 31 days, he does not satisfy the minimum criteria of 182 days, and therefore his residential status will be non-resident. Mr. B, who left India 1 week before Mr. A's departure, so his friend has already left India, is also a non-resident for the same reason. So both are non-resident. So now one NR is earning interest from another NR. Okay, one NR is earning interest from another NR, and money is invested in India for buying shares, not business. Not business, please understand, it's not money used in India in a business activity, in a commercial activity. It was an investing activity, it was a personal activity, you can say. Since section 915 provides for income by way of interest payable by a non-resident in respect of any debt incurred or money borrowed and used for the purpose of business or profession, for the purpose of business or profession carried on by such person in India, shall be deemed to accrue or arise in India. So the money, if it is borrowed and used for a business purpose, then only it is considered as income deemed to be accrued in India, not for any other head, my dear friend. Therefore, interest payable by non-resident in respect of the debt incurred or money borrowed and used for purpose of making or earning any income from any other source than the business and profession shall not be deemed to or accrue arise in India. So this is something new that we have to learn here. Okay, that money has to be only borrowed and invested for business purpose, then only the chargeability of section 915 will be attracted. Therefore, interest payable by Mr. A on money borrowed from Mr. B to invest in the shares of an Indian company shall not be deemed to be accrue or arise in India, hence not taxable in the hands of Mr. B. So these are the some of the questions that we have discussed on section 9.1 linked with the residential status and scope of total income. Thank you.